Hello, this is part 2 of the project finance lecture. Now this time, rather than just simply starting and walking through PowerPoint slides, I'm going to do something I should have told you last time. The slides and some other PowerPoint slides are on this page of the website. The slides on renewable energy project finance and this. I'm going to put this file right here, the one we were just discussing, because as I work through this video, I'll probably make a couple of changes to it. I also want to emphasize that the case studies, the Double, the Ras Laffan, the Eurotunnel, and selected others can be found on this case study thing. Now, I haven't, I'm still kind of structuring this. Oh, there's our nice picture of our project finance awards, this time for Petrozoata, Double, and First Solar, Iridium, Eurotunnel. Now, get my words out. You can find much more information on this stuff. For example, if you want to find the original prospectus, I didn't have the final prospectus, this offering memorandum. Somebody gave it to me. How fantastic is that? Get the real kind of things for the case studies. And then you can look at models for the case studies and kind of do your own analysis. So I think I didn't emphasize enough in the last one that I just had really scraped the surface. I think that was enough scraping of the surface to demonstrate the real key points. Now, as in this part 2, and I don't know how long it's going to take, so I might make part 3, I'm going to move from really risk analysis. And these ones up here, review of the essence of project finance, contract provisions, bank perspective, where I went through LLCRs and all that, they are all about structuring a risk analysis of project finance. And now I want to talk about structuring the contracts. How do we, structuring, not really the contract, structuring the debt agreement. Okay, got the sound okay. And the first issue is debt sizing. The next one's debt funding. How once we size the debt, you've heard me talk about this too much. How do we build it up? Repayment. How do we pay it down? In the middle of building it up and repaying it down, once you have the size, what's the interest and the fees you pay, and what are the other, I call them credit enhancements, or really credit protections. And then at the end I have some other kind of topics on selling projects at different time in the life, this business of risk reduction and all that. Now I'm going to, so let's move down. So we went through these ones, and I hopefully have fixed a couple of things with the arrows and all that. And we went through the PLCRs and DSCRs and really how to use them. And then some contracts. And really, I didn't emphasize perhaps enough here. I could do a whole long, day-long, boring course on this. Not boring at all. How do we evaluate costs to the off-taker versus cost to the project or the IPP? And then we talked about, if you don't look at the off-taker, that wonderful picture of Rebecca Mark, if you don't do, she's very successful again now, of course. If you don't understand the off-taker and whether they can pay the money, you've got nothing. And there's our awards, and this is the project IRR. So that was our kind of review. Now, let's go through loan structuring. I am going to make 2 or 3 points. Number 1, of course, I'm going to talk about the business of sizing debt versus with DSCR versus debt to capital ratio. There, I have a Rodin statute, to think about the philosophy. Then when I talk about debt loan repayment, and I'm going to talk about the kind of how it really works this time instead of just my simple modeling sometimes stuff. And I'll talk about development costs. And then I want to talk about this issue after we talk about funding. I'm sorry I'm going through it so fast. I'll come back. I'm going to talk about repayment. And it looks like the loan repayment is an enormous thing, because if we increase the loan repayment, the IRR goes up by a lot, and it goes up more than if you just change the interest rate. And if you say, here's the debt tenor versus the gearing, this has a big effect too. Oh, down here at least it has a big effect. So it looks like debt length has a really big effect, but that ignores refinancing. And refinancing, and that's how you have to evaluate mini-perms and all that, that just changes absolutely everything. And then after we go through sculpting for me is a lot about getting all these equations right. We'll talk about balloon payments and just how you can kind of get the effects of refinancing in those balloon payments on interest and fees. I'm trying to put together some theoretical analysis along with some data and talk about a little bit of what kind of interest rates make sense for different kind of loans. So let's start with this, okay? Excuse me, I'm going back quickly, okay? Just give you an overview of some of where we're going. Maybe you can stop the video now. So let's talk about the importance of project finance loan elements for different technologies. I am reading the PowerPoint. That really, really helps you, I'm sure. Okay, and here are 5. I made them into 6 because I split the debt repayment into tenor and type. Okay, and we want to look and use these things to evaluate the term sheet. Now, if you think a big factory, just because you spend a lot of money on a big factory, that means it's capital intensive, you're wrong. The most capital intensive thing I can really think of, perhaps, maybe there's something more, is a hydro project or a solar project. There's no O&M, it's got a long life, hydro especially, and you look at the O&M compared to the capital. It doesn't have anything to do with size, it has to do with the relative amount. And if you have something very capital intensive, I'm trying to show you in this one. Now, what I'm doing here is I'm going to get out of my PowerPoint slides just for a minute, and I'm going to say, where would you find the real analysis for this? And the place you'd find a whole lot of it is in this advanced structuring issues that I doubt a lot of people really look at, and I haven't really finished with anyway. And here, somewhere in the debt sizing, I have this file, and it's called, I hope, carrying charge. And that's where you'll find the file. So as I go through these PowerPoint slides, I'm going to tell you that. Now, what the idea of this file is, you look at different capital intensities. A diesel plant is very non-capital intensive, at least when it compared to other electricity plants, because it's got so much fuel cost. A solar plant, a project, is much more capital intensive. And then we look at these things. You look at the different things. Here's the debt to capital, the interest rate, the tail, which is the tenor, the style of the repayment, the DSCR. It doesn't have a funding analysis here. And then you can see, well, oh my God, if we have if we have a solar project, we start at 74 and we get down to 30. If we have a longer tenor, a higher debt to capital, a lower interest rate, and blah, 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 and a lower IR. Now, you cannot this is so hard to do for me because they're interrelationships. To make a checklist and say this is matters and this doesn't just can't be done. And you can't really say that the debt to capital is more important, because if you put that down here after you put these things first, it depends on the order of this stuff. I'm sure there's a way to do this better, but this shows you the diesel technology, and since all this blue area is fuel cost or operating cost, we have such a much less effect of this. Okay, and so that shows you, especially like I maybe should insert that thing in Africa, my favorite project, the Zambia solar project, where they got 4.7 cents because of good financing and low returns and all that stuff. Not low returns at all, but 10%. Now let's talk about the nuances of debt to capital. And the big issue is, which do you use, debt to capital or DSCR? Okay, now I don't put a lot of term sheets on my website because they're confidential. Okay, one of my favorite ones that I have in my classes is the term sheet for like a wind farm. And up at the top it says here's the maximum debt to capital. Down at the bottom it says here's what the minimum DSCR is. DSCR is determined by some kind of negotiated base case and downside case. It's forward looking. Debt to capital is determined by how much you're spending or you're expected to spend, so you can say it's forward-looking, but I'm going to say it's more accounting-oriented. Okay, and I think this is just such a key philosophical question. Now, there were some statues in U.S. of General Lee. They weren't Rodin. They were not good statues. They can be torn down. This one is beautiful, but he's thinking, should we... Here's the real philosophy. You've got to understand the philosophy. Should we trust the sponsor to be smart enough, I'm reading it, to not make a bad project? If it's ExxonMobil or somebody else, we hope that they're not going to be that stupid. But if Exxon and Mobil or anybody else, they don't have to put any money down and they only look at an upside, then how can we trust them? They have to have their own money at risk to really be sure that they're going to be careful with our project. Now, if it's DSCR, it's very different. We have a forward-looking analysis. We believe we can make a forecast. Okay, I'm going to pause this for a second because I need to change that slide just a little. Okay, I just added something here. I said, well, you know, if the DSCR, you have to believe you're smart. You have to believe you can make a forecast. This one, you're going to believe the sponsor's analysis. Here, you're going to believe your own forecast. And if you believe it, you can even put a variation around your forecast. So you can use all those kind of things like the break-even points that we discussed in part one. Okay. Then this is the kind of fundamental formula. The discounted red area where the discount rate is the interest rate on the debt, that is the value of the debt. That's how the DSCR and the debt to capital come into play together. Now, if you want to work through a whole bunch of exercise and really get deeply into this one, then you go to, actually it's in the same place, it's in this advanced modeling place, and you'd find this, I think one of the simplest ones. There are too many of these, I'm sorry. Toll road, mini-perm refinancing and all this. I just want this, the one that says debt structuring. Oh, shoot. Yes, sculpting and equal installments. That, I might rename that kind of as a fundamentals, a starting point for the analysis. Okay? All right, let's keep going. So that's where you can look at different, you can see if the tenor gets longer, you have more red area. If the DSCR gets tighter, you have more area for a certain forecast. Okay, and then you should understand which makes you more prone to run into which constraint. And if you've got a higher IRR on the project, then you've got a really big line. You're more likely to run into the debt to capital constraint because there's going to be so much cash from the DSCR. Same with the long tenor, same with sculpting versus a level payments that we'll talk about, same with the low interest rate. But then you go the other way. If the project IRR is low, like a Germany one or something else, then it may be the DSCR constraint that's going to drive you because you just don't have enough area under that curve. All right? And then this is actually that kind of model that I just showed you. It's the one I just showed you. So this shows you a little bit. I don't know, really, maybe I should have eliminated that one. Now we'll talk about this business of what happens. Here's what a bank will tell you. Here's what you might say. This is all a bunch of rubbish, you idiot. You might say, I look at, these bankers, everything's so smart. It's all magic. It's all magic. And the DSCR constraint and the debt to capital ratio are always the same anyway. They always result in the same thing. And here's what I'm suggesting. Let's say you have a model and you're a sponsor and your cash flow results in too high DSCR, meaning that you have a DSCR constraint. Just let me pause and fix that. So what I just said was completely wrong, sorry. If the cash flow is the DSCR is high compared to the DSCR, then you have a debt to capital constraint. And if you have that, here is your idea: increase the project cost. But don't spend more money on it. Oh my gosh, don't take more money out of your pocket. Just increase the cost with some, I don't know if they're accounting or other financing techniques. If not, try to increase your if it's the DSCR, if it's not and the DSCR is caused, see if you can get a longer debt to capital, use a bullet repayment, do all sorts of other things, and then you can kind of do both and just optimize like crazy. That might have been a little confusing, but, well, I'll try to explain it here. So things like development fees, owner's cost, some development costs that aren't real costs, like going to a first-class golf course or something, contingencies that are really high, they increase the project cost. But if you don't spend them, that's really good. You might have to give some of the debt back, but that's there. If you value the land, especially in real estate, put a high value of the land, that's not a real outflow. If you're the owner of the EPC, that's even good. I heard a story where the owner of the EPC, the project sponsor was not the EPC contractor, but they still wanted to play a little game. They said, increase your profit, Mr. EPC contractor, but give that back to us as the sponsor. So there are all kind of things you can do. Now, when you do that, they can have a big effect on the equity IRR. They can also involve how we allocate costs. They're significant issues. Okay, and if there are multiple investors if you assume that you're really spending money and that you're not spending money, it's a good way to allocate returns, let me say it, to different investors. Okay, and I talk here, you can read this stuff. If one investor is the EPC, you can use that, and this is kind of another thing. If you've got an O&M contract and you're making money with the O&M, there are tricks, and I haven't kind of gone through that. So here's what I try to do. Now this is, again, in that page. It's in that page on the website. And what I did is you just put increase this. Now if you have a debt DSCR constraint, you can put a whole bunch of development fees or not, and it doesn't make any difference. If you have a debt to capital constraint, you increase the development fees if you're the developer and the the owner, not if you pay the developer somewhere else. So you have to figure out how to do this. And I try to list other things you could potentially do. And then this is a development fee theory, which maybe I won't spend too much on. But the reason the developers should get a big fee is because of this probability. If you have 9 out of 10 times you're going to lose the project, you need to get a profit on the one project that's successful of 10 times the amount. You can't use IRRs for that. You have to have it. That's why development fees is not such a crazy idea. And that's why the accountants accept it, probably. I don't know. Haven't been in that. Now, here's an example. We have this wonderful Enron. It's very similar to the double structure. The O&M company was Enron. And this is somebody else who did this, some Euromoney guy. The Enron was the investor. Actually, there was a partner, but let's make it Enron the investor. They had a turnkey contract with Enron. So they get their profits in all sorts of things. Then we look at the sources and uses of funds. We see, let's pretend this is all Enron. They spend 28. That's how much they put in the project. I guess that's a pretty good debt to capital ratio. If you have working capital and a working capital loan, you probably should remove both of these, by the way. That's what seems to be done. But then, there's a bonus to the turnkey contractor, but that goes to Enron. There's a development fee and a cost that's really high, and that goes to Enron, except some of it was bribes, probably. And then you have this, in this number itself, there's profit, and that goes to Enron. I doubt they put any money into this. I think this 28 is all kind of pretend. And this is just details on the contract. So now we'll talk about funding. Now these were sizing issues, and then we'll go to funding issues. And I'm sorry to do this, but in that advanced issues, I tried to put a whole lot of files, and I'm going to have a separate video that I haven't made yet that go through things like during the funding, liquidated damages, shareholder loans, whether it's equity first or debt first, the timing of development fees, all these things that can occur during construction. Of course, if you have a very short-term loan, you won't see a lot. Now, here I just list some issues with funding, okay? And in general, you always want to put the equity in last and the debt in first. Now, for a class, what I would do is right now I would stop and make a little file. And the little file would be a very simple thing where I say, let's put in debt first instead of equity first. And then here's some just mechanical things, how you actually draw the money from the banks, how you get the money from the banks. Okay, and what do I have here? I just put in another slide. Somebody else is probably practice. It's usual for financiers to fund the projects. Well, of course, that's what you're doing because there's no money. And sometimes you roll up capitalized interest. That sounds like it's real fancy and really important. Now, I am in this, I'll go somewhere else. I'm not finished yet. In funding, debt funding, there are so many circularity issues you just don't know. And what I'm really trying to do is to work through some of these funding issues and give you I noticed nobody watched that hour-long video, but it's just the first of many hour-long videos on how to really, really make a automated UDF without all this horrible copy-paste business to evaluate the funding. Okay, so that's what we'll do. Okay, and so I talk about here capitalized interest, IDC. I don't care in text messages, but that's it might be interest during construction. I used to call that capitalized for accounting purposes, but we have to understand the difference between accounting for accounting and real payments. And the IDC, well, if the interest is paid or it's not, it makes almost no difference. If you're sizing the debt from the DSCR, then the debt size is independent of this issue anyway. And if you need to get money, then the debt size is going to be building up with the non-cash PIK, payment in kind capitalization. Wasting a lot of time and believing this is important. What an interesting thing to do, not only to show what's important, but what's not important. And what involves some philosophical, some deeper issues. And then here's another one. This is just accounting. Accounting can make a big difference. If we have pre-commercial cash flow, and this is another Harvard case study that they used to love that went bankrupt, of course, and that's the Petro Zuata. They funded this with 530 of cash flow, and they called that equity. If they would have said, no, 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 it's kind of like IDC. Where's the IDC? The IDC is in this other, no, financing and other fees, this big thing, other, net working capital and cash reserves. Putting these things in the, where you put this thing as a reduction in equity. Now, if you have, let's say you have interest income you're making on a bond, you've got cash during construction, you generally would put the interest income, subtract that from the IDC and put it up here. And then it would make a really small difference, but if you put the interest income down here and call it equity, it would make a really big difference. These little things can be enormous, and figuring out how to work with them can make a big difference. That's enough. Okay. And then, of course, on the disk, there are some examples of how that could work. And sometimes it might be a better strategy. If you could get it booked as equity, it would be a better strategy to stage your project. And then you are essentially, instead of taking dividends out, you're kind of funding the second stage of the project with that operating cash flow. Okay. Then we can talk about equity, equity bridge loans. This is so fascinating. These loans can only be made because you have a good sponsor. And if you have a good sponsor, or if the sponsor guarantees it, then, and what if you have a joint venture with one good and one bad? All sorts of fascinating issues. But should the benefit of that non-project finance, that guarantee from the or support from the sponsor be in the IRR and the equity? That's the kind of issue here. That's what I talk about here, and you can read it. Hopefully I've been clear enough on that one. And what I'm understanding right now is if I'm going to make that's why I hope you come to my class, because when you go through each of these, it's a whole lot better to go through each of the analyses with a simple little model. And then, what if we have a delay in construction? How do you model that? How do you if the delay means, that you're going to spend money later, it doesn't hurt. But if the delay means you spend it all earlier, it makes it really bad. And how do you put the liquidated damage in there to the EPC contract? Okay, and then if you have rooftop solar or you have real estate, this IDC can be an enormous pain. Okay, and then this was a little one on retaining funds. So if you pay your liquidated damages, you want to hold some money back, don't you? Because otherwise, if they got the money, they're not going to give it to you. They're going to do all sorts of things to stop you. Then let's talk about the length of debt. And the first thing. I used to start with debt repayment with sculpting. I rearranged it. The sculpting should begin with how long the debt is. And just remember, in corporate finance, debt is almost never paid. If you're paying the debt down, that's really bad because the company has stopped growing. It's really bad. Refinancing is all you do in corporate finance. If you put in corporate finance, what is the source of repayment, and you say cash flow, you are lying. The real source of cash flow is refinancing and having good financial ratios so you can refinance. But in project finance, we say, no, we don't do that. We just reduce debt. And if we have a 10-year debt life for a 50-year hydro plant, we say, we're going to have no debt associated with 40 out of the 50 years of the plant. Can you believe that? See how different that is than corporate finance? In reality, there's a little bit of a mixed bag because that hydro plant should refinance. And I haven't done enough of this on the website in that advanced issues, and that's why I haven't really made one. Okay, now what I did, here's some kind of stuff on different kinds of loans, and you can compute the average loan life, and if I have this class, if this was part of a class, what I would do is make you do a little analysis here, and you'd have to compute the equity IRR. I'd probably just have a flat thing with no taxes, and then we say, okay, if here's the debt to capital with it doesn't have the tenor, but this is a much longer term tenor, and it's got a higher IRR. Okay, but refinancing changes absolutely everything, because if you put a new refinancing here and then put in here, assume that you were going to refinance, you might not get all the 9.04, but you get a lot of it back. That philosophy that you have concerning refinancing is so important. I'm sorry about that. And if somebody tells you, you're not allowed to refinance, that's like I have to assume an oil price of 0 in my forecast. I can't say that about an interest rate. So here, if you make a two-way data table, so what I would do in a kind of basic class is go say, okay, let's put different lengths of debt and different interest rates and kind of show you, look at this. This makes a really big difference. This doesn't make much of a difference at all. It made a little more of a difference here, demonstrating that there are these difficult interrelationships, and of course you have to have a higher interest rate than the project IRR. That's no taxes in this. Okay, if there are taxes, it's a little trickier. And then I do the same thing with gearing. Now, if you have no gearing, nothing matters. If you have middle gearing, then here's the debt, going up. And it's kind of hard to see, but if you have a really short-term life, then it doesn't have much of an impact, and a long-term life has a really big impact for the gearing. So again, there's this interrelationship, but the length of the debt really matters, but you're ignoring refinancing. And if you have a mini perm, I'm not going to go through all the details of the mini perm. Essentially, don't get intimidated. I first heard about this. I thought, this is so complicated. It's so complicated. Once you understand that you just have an amortization period, and then you just refinance the stuff, the repayment that's not repaid over here. Okay, it's all about refinancing again. It's all about refinancing, and making an analysis of this is tricky. No, it's not tricky, but you have to make a refinancing assumption. It forces you to do it. If you're the bank, you have to make a better kind of assumption, which you have to say, can the company pay its loan off by the end of the life? And you can do a downside case if it switches to a cash sweep. It all suggests that we really should be looking at project life here, I guess. I don't know. And then we can talk about sculpting now. This is all geometry. The structure of the debt seems to be so important when you have different patterns of repayment, and everybody now uses sculpting because it's fancy and it sounds like we're doing art. Okay, and there are different kinds of sculpting you can do. If you have, maybe I should have put a little graph here with a step-up rate, because that's almost like sculpting when you have all these things. And here's an example, a real-world example, where this was the repayments, and I guess they did maintenance in one period or not the other or something. This was a kind of flat, and then the one debt repaid, so they sculpted. This is the facility that was used in the sculpting. And this shows you now, if you have the DSCR constraint, then here, this DSCR and this minimum DSCR are the same. It seems that sculpting is enormously important. If you have the debt to capital constraint, then it's a lot less important. And if you could refinance here and refinance here, it might lose all of its importance. Okay? So it's all very interrelated. That's what makes it very interesting. That's what limits really this whole business of making a little checklist. Okay, and we can have different repayment patterns, and then we can have balloon payments in some transactions. And I think when you go through sculpting, you need to understand the basic kind of equations. Now, if this was a class, I'd have people do it, and you can start with a basic case, and there's a whole sculpting class. So this is a related there's my RFI. This is related to the in the website here. Everything in project finance is kind of in the first area here, and on this one I have a whole sculpting course. Here's building a rooftop, and my badge that nobody has ever got. And then we have all our sculpting videos, and there's kind of an overview, and you go through all of these things, which are painful things to do. Okay, and I only learn these things by people asking questions. And the first thing is, well, if there's a varying interest rate, use a sum product, and you say the sum of the cash flow divided by the interest rate. That gives you, that's not really the debt amount. I have to fix that. Just a minute. Okay, that's why I'm going through this. I told you. Got to fix that on the website too, I think. Oops. And then we go through other things. What happens if you have a debt to capital constraint? Then you can do this LLCR trick, because I showed you in a way above, we saw that the debt to, we saw that in sculpting, the DSCR and the LLCR are the same, and you can use that in a tricky kind of way. And then if you have fees, it gets a pain. That's almost why I made these equations, to remember what to do if you have fees. Now, if you're modeling, and, you know, I would never remember this. Maybe you would. Maybe you can stick these formulas in your brain and just put them there. And then if you have a DSRA, because why don't you, for the last payment, just say, we'll use any cash that's in the DSRA account. And then you can put that in, and this is going through what happens in Brazil, or how to adjust the O&M contract if you have sculpting to make it, or if you have don't have sculpting. I call it synthetic sculpting. If the bank is saying, I'm just going to be stubborn, I'm not going to do anything for you, I'm going to give you fixed payments, then you sculpt, then you change your O&M contract, or change your EPC contract, or do whatever you can to try to put different payments around and go into it backwards. That's not really a very good graph to demonstrate that, I guess. Okay, and then I talk about, here, let me just talk about a balloon payment for a minute. Here's this, and this is another file. There's a video on this file. I thought this was an important file. And this says, what's the equity IR? So we have a base case, aggressive financing case. Now, if you have something like a PPA contract, you really may want more analysis on structuring than on the risk analysis. And if you have a really aggressive case with high debt to capital, low coverage, low margins, low interest rates, different development fees, then we get a higher IRR in aggressive case, and then we can look at item by item which causes the highest and which is kind of doing it. But then you add a balloon payment, and this time I didn't put it in here. I got to put what kind of balloon payment, and I'm going to, I think, pause the video and try to remember what kind of balloon payment we had in here. Now, this analysis came from debt structuring and balloon payments, which again is on the disk, but if you want to find it on the website, again, it's in Advanced Project Finance, and it's in the repayment section. So all of these kind of files that go through these issues, and in this case, watch me have a 0. I had a 15% balloon payment. This one I said we're going to get a target IRR and look at the DSCR, but I'm going to show you where that is at least. So, just a minute. Okay, so now if I had a class, this is with a 20% balloon payment, and I said, look how the equity IRR goes up, especially, oops, I'll leave it like that. Especially in the high case. Now, to do that, the modeling is really tricky, I think. To do that well, I think you should be able to see that what you really want to do in modeling is not necessarily make these enormous, beautiful, artistic models with all the special colors that the different providers tell you to do. You need to be able to model things like this and see in which cases it really has an effect and in which case it doesn't. Now, I think I'm going to stop the video because, number one, I'm a little tired, and number two, the video's gone on for too long, 42 minutes. So this is going to be part 2, and I'm going to have a part 3 that goes through all the interest rates and the fee issues and relax a little more about it.